Hey everyone, in today's video, we're putting a Chaikin Money Flow volume trading strategy to the test. We'll code the entire strategy in Python, optimize it using Freqtrade, and run backtests to evaluate its performance. Let's dive in. Before we dive into the coding, let's first break down the key indicators we'll be using in this strategy. Chaikin Money Flow, CMF, is an indicator that combines price and volume to measure the flow of money into and out of a security over a set period of time. It helps us understand whether buyers or sellers are dominating the market. The formula takes into account the closing price relative to the high and low of the day and multiplies this by volume. The result is then smoothed over a moving window, commonly 20 periods. In simple terms, when CMF is above zero, it indicates buying pressure. When CMF is below zero, it indicates selling pressure. We'll use this signal to guide our buy and sell decisions in the strategy. Let's move on to the second key indicator in our strategy, the exponential moving average, or EMA. The EMA is a type of moving average that gives more weight to recent prices, making it more responsive to new market data compared to a simple moving average. In this strategy, we'll be using the 200-period EMA as a trend filter. It's a widely followed level by traders to identify long-term trends. If the price is above the 200 EMA, we'll consider only long trades, following the upward trend. If the price is below the 200 EMA, we'll consider only short trades, aligning with the downward trend. This helps us avoid trading against the market and reduces false signals from the Chaikin Money Flow. Now that we understand the key indicators in our strategy, let's dive into how we can apply them to analyze trends and generate trading signals. To enter a long trade, we need all of the following conditions to be met. 1. The default CMF window is 20, but it can often be too sensitive and generate noisy signals. So, we increase the window to 40 to smooth out short-term fluctuations and better capture stronger accumulation trends. 2. While CMF above zero indicates buying pressure, it can still produce false positives in sideways or low-volume markets. To reduce false signals, we require the CMF to cross above 0.05 or even 0.07 to ensure there's meaningful accumulation and strong buying pressure behind the move. 3. To stay aligned with the overall trend, we apply a 200 EMA filter. We only take trades when the closing price is above the 200 EMA, confirming we're trading with the trend and not against it. Once all three conditions are met, we enter the long trade on the next candle. For risk control, we're using an ATR-based stop loss, which adapts to market volatility. The formula is signal candle close minus 2 times ATR, using the average true range. ATR allows our stop to adjust to market conditions, avoiding premature exits from normal price fluctuations. For the take profit, we apply a classic 2-to-1 risk-reward ratio, placing the target at 2 times the stop-loss distance. This ensures that even with a 50% win rate, the strategy remains profitable over time. If a candle closes above the take profit level, we exit the trade and lock in our profits. Then we can see here another clear signal. The CMF crosses above 0.07, and the price is still above the 200 EMA. That checks all our entry conditions, so we go ahead and enter a long trade right here. We set our stop loss just below the signal candle using the ATR method, and we place our take profit at 2 times the risk, following our 2-to-1 risk-reward rule. As you can see on the chart, this trade hits our take profit target. Now let's take a look at how we enter a short trade. To enter a short trade, we need all of the following conditions to be met. 1. Just like in our long strategy, we use a CMF 40 to reduce noise. But this time, we're looking for negative values, which indicates selling pressure. 2. While CMF below zero shows general selling, that might not be strong enough. So we wait for the CMF to cross below minus 0.05, a signal that distribution is gaining strength and sellers are taking control. 3. To align with the overall downtrend, we check if the price is trading below the 200 EMA. This helps us avoid counter-trend trades and increases the probability of success. Once all three conditions are met, we enter a short trade on the next candle. Just like before, we calculate our stop loss using the average true range. This gives the trade enough breathing room, while still protecting us from large, unexpected moves. For take profit, we again apply a 2-to-1 risk-reward ratio. If a candle closes below the take profit level, we exit the trade and lock in the gains. Now that we've covered the strategy, let's move on to optimizing it for better performance using Freqtrade, a free open-source crypto trading bot built with Python. If you want to dive deeper into Freqtrade, check out the full course linked in the description. Here's the plan. We'll test the strategy on the 1-hour time frame. The data is split into 2 sets. In sample, 8 months, used for tuning strategy parameters. Out of sample, 4 months. Used to test the strategy on unseen data, we'll focus on optimizing the following key parameters. CMF length, the window size for the Chaikin Money Flow calculation. We'll test values ranging from 20 to 50 to find a good balance between sensitivity and stability. CMF long threshold and CMF short threshold. These define the minimum CMF values required to trigger trades. We'll test a range from 0.03 to 0.09 to filter out weak or false signals. A-tier multiplier and risk ratio. These are used to calculate stop loss and take profit levels, dynamically based on market volatility. Adjusting these values helps manage risk and improve the risk-reward profile of the strategy. We'll use Freqtrade's HyperOpti tool to find the best combination of these settings, aiming to maximize profit while minimizing drawdown. Once optimized, we'll run a backtest to see how the strategy performs with real market data. All right, let's take a closer look at the backtesting results. The backtest was run on STX perpetual futures using a 1-hour time frame over the past 1 year with the optimized settings. Now, let's break down the results. The total profit achieved was an impressive 316%. During the same period, the market itself experienced a 60% decline, highlighting the effectiveness of the approach. The maximum drawdown was 22%, which shows that, while there were pullbacks, the overall profitability remained strong. Next, let's take a look at the visual summary of the results. As you can see, the graph is in a clear uptrend. This indicates the approach's ability to adapt to different market conditions. If you'd like to download the Freqtrade strategy file and dive into it yourself, be sure to check out the link in the description below. I've also created a pair-optimized version, allowing you to trade multiple pairs in one setup, each with its own fine-tuned parameters for enhanced performance. If you found this video helpful, don't forget to hit the subscribe button, turn on notifications, and share it with your friends. Thanks for tuning in, and I'll catch you in the next one.